Well, the South African Revenue Service says normal income tax rules will apply when it comes to the taxing of cryptocurrencies. Taxpayers will be expected to declare cryptocurrency gains or losses as part of their taxable income. Joining us to make sense of that is Ettiene Retief, who is with the South African Institute of Professional Accountants. Thank you so much, Ettiene, for your time today. So how has SARS been treating cryptocurrencies up to now?
Well, one of the questions was that we need something from SARS to ensure that taxpayers understood how to correctly tax it so that we can have a consistent way of doing it, because there's been some taxpayers that have not been too clear about how to properly deal with it. This is where SARS has come back and said, well, we already have rules, the normal rules apply, and if you apply them correctly, it gets the right result. The only one that is that needs some legislative intervention probably is the value-added tax rules, because there are some anomalies to deal with. But for normal income tax purposes, the rules will generally apply.
Okay, so give us an example.
Okay, so like in any circumstance where I do activities, I have to define, is this normal income tax that will apply? So do I have gains that's going to be part of my taxable income, or is this something that's going to fall under capital gains?
Okay.
And likewise, if I trade with cryptocurrencies, I use it as on a trading platform, I'm no different than any other form of trader. So I make gains and losses on a daily basis. I'm entitled to claim deductions for losses that I make, but that's fully taxable gains.
And determining their value, you know, because we know how volatile cryptocurrencies are. Just look at what Bitcoin's done over the past few months. How do you determine what the value? Unlike R1, you know, you can compare it to the dollar or the pound or the euro.
Well, effectively, there'll be a realization. So if I spend, let's say, 200 Rand to buy something, that's the cost that I incurred. If I sell it for 300, that's the return that I've got. Okay. So I do not need to really value that in between. The difficulty was that if I'm holding it or I'm trading with it as a form of commodity of swapping, so I'm buying something and instead of using normal cash to pay for it, I'm using a cryptocurrency to pay for it. How do I deal with that? There were even questions as to should it be dealt with in terms of average value valuation type of rules like we do on shares. So SARS did provide clarity that it cannot be regarded as a share, and we would use the normal principle of looking at the actual cost that you incurred or the income that you got at the time of earning it.
Okay, so on the outside of the purchases or sales, what about the mining itself? How is that dealt with?
So mining, and this is where SARS provided some clarity, and it is in line to what we expected it to be, is that when I earn, and our income tax system works very much on the point of that we tax not necessarily when you actually receive, but also when it accrues to you. Yeah. So it's the earlier of those two dates. So when I mine, I become entitled to something that I can swap and I can trade with. The moment that I've earned it by physically, I get a coin, for instance, for mining. Yeah. That point of earning that coin is the point of when it's income in my hands and I have to be taxed on it.
All right. Now, the thing about cryptocurrencies, whether it's Bitcoin or any of the others, is that people trade on the anonymity of it. Yeah. Right. So will that have any impact on the administration capacity of SARS?
Well, look, the cryptocurrency is a very interesting technology because it brought in peer-to-peer type of transactions. So it's between the two parties. There's essentially a cryptography that is used to secure the transaction, but the actual transaction afterwards is kept in a public ledger. Yeah. And that's what essentially the building blocks of that is this public ledger that we have. And the problem is that public ledger, although it has all that information, is that the identikit of the person is not known because it's based on similar to an ID number. Now, without knowing that, it's very difficult to find out what those transactions are. So yes, there is anonymity, but the thing is that that's anonymity in the transaction between, let's say, the peer-to-peer.
Yeah.
But when I'm using this to buy or to pay for a transaction, there's another party to this. If I convert this to cash or I use cash to buy it, there is still another party that is in us. So there are many ways through third parties or where there are cash elements involved where you could still track it, you could still see the transaction. And I think from that point, SARS has access to it. But I think the most important part is that a taxpayer must understand that although today we have an understanding of what the risk is or what information is available, when SARS looks at this, remember they could look at this in a year, 2, 3 years from now with different view backwards. So the risk is going to be there. So I would advise taxpayers to be cautious to think that they can trade on the anonymity.
Until SARS has a system. All right, we'll leave it there. Thanks for your time today, South African Institute of Professional Accountants, Ettiene Retief.